Hey there, welcome to the channel. So today I'm going to look at the CPI inflation nowcasting. So there's this, there's the different regional Federal Reserve banks, and we're familiar with the St. Louis Fed. They have a bunch of data, et cetera, et cetera. But there's also the Cleveland Fed. And one thing they have over here is they have what they call nowcast, inflation nowcasting. And what it is, basically, is they're trying to estimate what the inflation numbers are going to be. So I wanted to take a look at that today and see if we can get kind of an estimate for what might happen with the CPI numbers that are for April. So the CPI numbers being reported for April are coming out on, I believe, May 11th. So it's coming out this week. Okay, so now I can go to this macro micro over here, and they have a better chart with it. And one of the things I'm going to focus on here is we're just going to look at the blue. The blue is the consumer price index. The yellow is the Cleveland Fed inflation nowcast. So let's just look at the year over year. Okay. Now, what you'll notice is the blue bars are the actual CPI numbers. These are the release that you get from the, the BLS or whatever the organization is, right? But the yellow bars are the inflation forecast. Now, so what you have is, if you look over here, we had 8.5% year over year CPI reported basically for the previous month. And what's coming out right now for April, okay, the April report is coming out this week. And you see there's no blue bar because they haven't released the numbers yet. The CPI numbers have not been released, but what we have is the estimate. So if you look at the estimate here, they're estimating 8.14%. And then they're also estimating for May, for the month that we're currently in, that it's dropping to 7.88%. Now, one of the things to look at here is that if you look at this, notice how these are pretty close. So the blue is the actual reported CPI, and then the yellow bar, let's call it yellow bar, is the actual forecast. Now, the yellow forecast is changing all the time, so you got to kind of keep that in mind as well. They're updating it, I believe, every week. But you can see it as you get to that final point, you can see that the reported CPI is a little bit higher than the nowcast. But there's a decent correlation. In the big picture, the graphs are all moving up together. You can see that there's periods of time back here where you had the CPI numbers that were actually reported were significantly higher, but you can see the trend. So the point is, what am I seeing in this chart? I'm seeing what looks like, I mean, it's possible that this week, the numbers coming out for CPI for April, that it's possible that there could be a divergence. Like you had a period back here where the CPI was much higher. Now, if that's the case here for this month coming up, then you'll see a divergence. And what you'll see is that the CPI is continuing to increase. But if that's not the case, if we see that this correlation between the nowcast in the CPI inflation hold, then what it's already showing, if we just take these numbers, the nowcast numbers, this is already for April, right? This is the April. And then also we already have a preliminary for May, which is we're in right now. And if we just take it at our word at this point, now just keeping in mind that, CPI could actually be reported, but it appears these correlate reasonably well. Looking at the chart, they reasonably correlate. So what does that mean? So what does that mean that's likely to happen this week? It means that inflation may be peaking. And the nowcast model, this Cleveland nowcast CPI thing, is showing that. Now, we'll see this week if that's going to hold and the nowcast is going to be right, but it's something to keep in mind. So going into this trading week, when we get the CPI, which is, been pretty bad, very high CPI, we're in high inflation right now. And we had a pretty heavy duty sell-off on Thursday, after the day after the Fed meeting, and then Friday was a little more of a sell-off. So what I would say is this is something to watch out for, because this could end up creating some kind of a rally or volatility or something like that, because what it will show is this will probably be interpreted as, hey, inflation has peaked. And so what they're going to do, so this is what's going to happen. On the bull side, The bulls are going to be like, look, this is proof inflation has peaked and now it's going to start coming back down. And therefore, and thusly, the Fed is not going to have to raise rates as much as they're saying they're going to. That's what they're going to say. So this is the bullish argument. They're going to say, hey, look, inflation has peaked. Inflation is done. We're through this thing. Yeah, it was transitory. It just wasn't, it just took longer than we thought. And therefore, it's coming down. And so now they're going to be expecting it just to continue to come down throughout the rest of the year. Okay, so that's the bullish case. And, you know, who knows? I'm not giving financial advice. I'm not predicting market bottoms, market tops. I'm not doing any of that, but this could add to volatility. This could add to a bullish case. It just depends how it comes out, right? So that's the bullish case. The bearish case will be, you know, basically you look at the, you know, the Peter Schiffs of the world, and me as well. I mean, I don't think that this thing is done, but this does show that, yes, there is a near-term peak. Now, I would use an engineering term. This could be a local maxima, or, I mean, it could be a peak. But the point is that, yes, it looks like it's going to inflect down. And if this follows through, but this doesn't mean that it's going to just go all the way back down to the floor over here. It very well could come down a bit and then level out at higher levels. This would be more disinflationary. So, you know, the point is that your inflation is in the 8% range here, 8%. You know, ideally, you know, you'd really want to get it back around 2%. I mean, the Fed was like 2% target. I mean, at this point, the Fed would be happy with 4%, but, you know, it needs to come off significantly, and it's not coming off very fast at this point. So the bear case is that, hey, look, yes, it came off, but it's just a little blip and we're still at sustained high inflation. So that's the bearish case for this. The ultra bearish case would be that, like, hey, look, this is just a local maxima, which means it's something like that. And then you're even going higher. Now, I don't know that we can go higher. I don't know how sustainable it is to actually have inflation go much higher than this point, but I'm more along in the camp that, hey, it's going to be persistently high for some time. And so I don't think that conceptually we're out of the woods, and I don't think conceptually that the Fed thinks that we're out of the woods. This could end up being very bullish for the markets. So that's it for this one. Talk to you later. Bye.